Sounds good.
What's up, Outliers? Welcome back to the Outlier podcast. We have a familiar face, Andrew Mack. He was on a little while ago, and we covered a lot. As you could tell, I'm on a slightly different setup. I am traveling right now, checking out the frozen landscape of Alaska, which, Andrew, you're in a typically pretty cold area too, if I'm not mistaken. So this is nothing new to you. Is that about right?
Yeah, we just had 2 feet of snow dropped on us today, so you're in good company today, Eric.
There it is. Awesome, man. Well, I am absolutely stoked to catch up again. Last time we spoke a lot about kind of like some core fundamental concepts of trading, options trading, edge, sports betting in relation to options trading, developing models. And I've been on a recent kick where I'm trying to connect a couple more dots, specifically as we were just talking, like kind of like the late stage beginner, early stage intermediate, which is all just kind of random terminology. It doesn't really mean anything other than the fact that I'm expecting the conversation to be more for people that already know like what derivatives are, what markets are, like that kind of stuff. And we can move a little past those concepts. So the first thing that I thought would be really, really cool to discuss broadly is right now it's towards the end of November of 2025. And if you look back over 2025, what are some of the things that you have found that have worked well and some of the things that haven't worked well? And feel free to bounce between, equity markets and sports betting at your leisure. I know that you're involved in both.
Yeah, I mean, we should probably stick to trading and financial markets to the extent that we can, just for the benefit of your general audience. But the one thing that came to mind immediately as you said that was MOC, market on close, just that how much that has faded compared to the kind of Wild West days when we had zero DTE options for every single day of the week, and you had some really, really big bursts and rebalancing events at the end of almost every day. And there were some really interesting opportunities with that where, you know, you're picking up some dirt cheap options because there's zero time left on the clock, and you could watch these things go um, significantly into the profit to the tune of 5, 6, 10, 12x in the last like minute, 2 minutes of the day. So it's very stressful. It's very, very high blood pressure type of an activity, but very much in effect. And you've watched that sort of slowly wither away and die over the last, I don't know, 6 months or so, something like that. You still get the occasional, we still see the occasional burst, but it tends to be more mechanical. It tends to be like an end of the month effect. It tends to be new all-time highs. There's some kind of other catalyst other than just the MOC. So that's something that sticks out as like that used to be, um, a real powder keg, and now not so much. I usually don't even stick around to see what happens in the last 10 minutes of the day. What's worked well? Um, well, I mean, that's sort of contextual. It depends a little bit on what it is that you're trying to do. Long vol has been working really well for the last what month or so at least, right? What you're seeing, right, is that as the VIX is elevated, right, as we get past 20, 21, 22, when a straddle implied break even gets broken, we tend to see a little bit of a trending activity towards the second standard deviation rather than a reversion back into the straddle implied break even. And so you've seen trades that sort of take advantage of that effect in the last month work quite well. Um, but that's, again, I don't think that's anything magical. As the VIX starts to come down, we get back below 20 into that kind of like 16-ish range. You tend to see more reversion back into the straddle implied break even. So it's just one of those market dynamic things to be aware of, whether you're long vol or whether you're short vol.
Two questions. The first one for the market on close effect, which is funny because it's actually one that I trade on both sides of the coin, actually. And typically not right on close for the short side, but a little bit before that. When what is the mechanism that you stumbled across that. One of the things that I'm trying to help traders learn for themselves is creating like this baseline understanding of markets and then looking for things that just kind of look weird, but that's hard to do when you don't know like a deep level of baseline and then like what weird is. So can you
Right.
just give us like a quick overview of even how you came across, how the market behaved towards market on close, and then some of the ways that you determined if there was something viable there for you?
Sure. So something that I've said a couple of times is that the best effects start by noticing something weird, as you just alluded to, rather than diving into the data and hoping to find the effect that way. It's usually better to notice it as an observation and then to sort of investigate. Most of my best ideas have come that way, so it is, what I would recommend. You have to keep your eyes open, and that means that you're going to spend a lot of time looking at stuff that work turns out to be nothing. That's just sort of part of the game when you are a treasure hunter, right? So with the MOC, what I do, like one of the things that I have on my screens at all times is the full options chain for 0 DTE SPX. I also have the Qs and I have ES future options as well. But so just watching that with some other things, you're watching the spreads at the end of the day, and you're watching, obviously, the spreads start to get quite wide as the vol starts to pick up. And that's not necessarily anything, just market makers saying, hey, go away. We're not really interested in paying you out a massive amount of money for these things if something crazy happens. So it's kind of a fuck off spread, right? They're just widening it out to tell you to piss off, and that's fine. But every now and then, you notice that the spread that they have widened it out to get you to piss off wasn't wide enough. And the thing kind of breaks past the break even on the widened spread. And so you sort of make a note of that. Like they
Mm.
widened this out and it wasn't enough. It kept going and it looks like it would have done, that one would have done 3x. So you make a little note of that, 3x even with the widened spread, whatever. And you note what day it was, and you note if there were any catalysts on the economic calendar that day, blah, blah, blah. And over time, you start to sort of, okay, it looks like maybe there's something here. Maybe there's a way to take advantage of this. And then on the weekend, you might go into the data and then actually try and see if you can find something that indicates that you're onto something, right? But that was how it came across the MOC thing.
It's funny because like when you do this for a while, exactly like you said, it's kind of how you come across most stuff, right? It's just like you're like looking at something and then you see something. I find a lot of times when I'm speaking to newer traders, a common concern, which is completely fair, is that of like, how do I know if what I'm seeing is something viable versus if it's something that's just kind of, once in a while, this end of day move exceeds what they're pricing the bid ask spread at. You mentioned an important part of that I want to double click into, which is you have this observation, you have this thing that you're like, this looks kind of interesting. And then you talked about like over the weekend or obviously whenever, doing a little bit of data analysis to try to like contextualize it. Can you talk about that process a little bit? Like, what are you looking for when you're doing that analysis?
Well, you want to try and take a look at, for example, the spread widening versus like what actually happened. What was the realized move? Because you'll be able to see like, hey, are they effectively widening these spreads out enough that they're negating the opportunity to pick a direction on these things or to take the other side, like you said. And what you're going to find is, there'll be some times where they've got it covered and there's nothing doing there. And then there'll be other times where it looks like they didn't widen it nearly enough to cover the opportunity. And so what you want to do, at least what I do, and this is sort of a creative thinking process, right? You try to put the critical mind aside while you're brainstorming and being creative, because you can always be critical after you have an idea. But you start with a sort of creative mindset and you say, okay, here's one where they didn't widen it enough. What are some things we can associate with that may give us clues for when this could happen again? So like the day of the week, and we just start trying to brainstorm and say, okay, let's try to find some associations that we can use to maybe try to find other times where this could happen. And then you'd go back and try to, critique it you try to knock the idea down after you've sort of built up a hypothesis, right? So it's we start creative and then we get analytical and critical, and it's going back and forth between those two modes that allows you to generate an idea and then discard it or stress test it, right?
It's funny is you started talking. One of the things I took a note on that I wanted to follow up on is this idea of like balancing knowing about something versus like doing, because you could spend weeks and weeks, right, trying to analyze this effect and understand all the nuances and all this kind of stuff. Meanwhile, it might not be there for that long, or it still might have been profitable even if you didn't know everything about it. So what's like the degree that you need to see in order to feel comfortable starting to move something to production? Obviously, you could go ad nauseum and then effectively just overanalyze and do nothing, which kind of the analytical people do. Then you have the other side of the coin, the people who just jump off the cliff and then hope the water's deep enough. So typically a balance, but curious your process there.
Well, it depends a little bit on the type of stuff that you are after, right? If you are a risk premia guy or girl, that is something where you can analyze it to death because it doesn't go away just because people know about it. So there's nothing wrong with really getting, going hard on the data analysis because you're going to find more and more information to sort of contextualize the effect when it's better, when it's stronger, when it's weaker. Um, I would say that at some point there is an analysis paralysis that kicks in where it's like, the whole point of this is to trade to make money, and you do have to like fire at some point. So, and we talked about that actually, I think in our first
Hmm.
podcast together, if
Hmm.
memory serves. But um, so there is that balance, and it does depend on whether you're after risk premia or whether it's more of an inefficiency or flow effect or something like a transient effect. Um, I think that transient's a better word than inefficiency because people get really particular about inefficiency and the secrecy around and stuff. There are transient effects that aren't really inefficiencies, but they don't last very long, right? So like news catalysts, a flow effect. I don't, just a transient type of thing where it's a big wave and then it's gone and the water smooths out again. And so for things like that, it's really not a good use of your time to be trying to um, console yourself with extra data analysis, right? It's at some point you're going to have to just decide, size your risk correctly and take a shot and start recording your data. Um, and that I definitely tend towards that because most of what I do is on that side of the equation rather than risk premium per se. Like I'm not a volatility seller. I'm not short vol. Typically, when short vol is performing very well, the equity risk premium is also performing well. And so, for me personally, I would rather be partaking in that, usually with momentum on single stocks, strong sector stuff, things like that. So, when short vol is performing well, you can usually find me in single stock momentum stuff. And when short vol isn't performing well, you can find me on long vol on the indices. It's kind of like my general like 30,000 foot view playbook. Um, but yeah, I mean you don't want to wait around all day with the data analysis stuff. The whole point of some of these effects, especially the stuff that retail can take advantage of, in my opinion, you're going to have to operate with imperfect, incomplete information, and that's true of a lot of things in life that have positive skew payoff profiles, right? Like like would anybody get a date at a bar if they had to wait for perfect complete information before they went up and talked to a girl? Do you know what I mean? Like do you need perfect information or do you, at some point you just have to say, well, she's smiling at me. She laughed at some of my jokes. Maybe I should ask for her phone number, right? Like it's the same kind of a thing. You're going to have incomplete information. You have to make a decision and size the risk appropriately. So I think it's very applicable to a lot of things in life.
Yeah, I think that's absolutely solid. And now when you come across, let's say, anything of interest, so this market on close effect, the general long ball playbook side of stuff, when you're in this creative mode, do you start from a point of I'm going to look in this specific space for a while and see what I see? Or do you kind of look around and just see if something sticks out to you? What I'm trying to explore here a little bit is the fact that for a newer trader, a lot of times, I mean, it's the ocean's huge, right? So you can spend forever just looking at a ton of different things, but not enough detail to really see anything. And then sometimes you could spend too much time looking at one specific thing and then lose a bunch of other stuff. So again, like we are just talking about, there's like this balance. So when
Mhm.
you're in this idea generation kind of creative phase, looking for new things and ideas, how do you approach that problem set?
Well, I would say for most people, a really important point would be that you need to understand the mechanics of the game, how the game works, in order to figure out what's worth taking a look at.
Mm,
So, if you're going to spend time actively focusing on things, it's really important to know how the pieces fit together so that you can generate better ideas of places to look. It's like saying, if I want to hunt deer, it's kind of handy to know where deer like to sleep and where they drink water and where they might be walking to and from, because those are going to be the places we're most likely to find deer, right? Or waterfowl or salmon or whatever, right? Like you have to have some concept of like how the ecosystem works in whatever it is that you're looking at. If you don't, it's going to be you're going to have a lot of hit and miss stuff because it might be something useful and it might not be, and you'll have a difficult time discerning which is which because of your incomplete information about how the game works. And so if you're going to put a lot of time into active learning, I would suggest that it should be into the mechanics, right? Like you should be a student of the VIX complex. Like how is VVIX calculated? What is it telling you? What's its relationship to VIX? How is the VIX calculated? What is its relationship to the options chain? Like you really need to understand this stuff like at a reasonably deep level in order to notice things that are genuinely weird. Once you have some concept of how the game works or the broad pieces, like this is what the knight does, this is what the bishop does, etc. Um, my personal view is that it's better to just kind of just look around in a relaxed way without any sort of preemptive motivation. You tend to find the best stuff when you're not motivated to find things. It's that Buddhist aphorism about motivation affecting perception, that you tend to find what you're looking for, and so you can create mirages for yourself if you start with this idea like, okay, we're going to find something today in vertical spreads, and I'm going to find it, and then you just start. Your brain kind of like starts inventing things to try to prove you right. Much better, in my view, to just kind of look, just see, and then make notes about what you see. And like I said, most of it'll end up being probably nothing, but every now and then you find something that's really, really interesting, and you can probably make some dough with that.
I love that. It actually reminds me of a story that I told not that long ago, actually. It's when I was hunting, and funny enough, I was deer hunting in New York, and this was like one of my first hunts. So I was like sitting there in this blind that I spent a while building, and I was so stoked, right, to try to find something. And I saw this deer, and I'm sitting there looking at it, looking at it. I'm like, man, like I just need this thing to get a little bit closer. And I was sitting there looking at it. It must have been for like 20, 25 minutes. And then it just got like a little bit lighter. So then I finally got to the point where I could move a little bit. So I bring up my optic and it's a fucking stump. I watched this stump deer for 20 minutes. I'm seeing it move. I'm seeing everything. And it's a fucking stump. So your example there is actually massively, massively important, I think. And for the hunting example, it was easy for me once I could see with clarity that this was a stump and not a deer. In trading, what are some of the tools that you can use to validate if what you're seeing is something worthwhile or if it's a stump?
Hmm. Well, repeatability obviously comes to mind in terms of seeing something more than once, more than twice. Um, Obviously, if it's just something that happens once, it's a little bit difficult. But as an example, right? Like take any. any options contract of zero DT, like say we just at the start of the day today we pull up um, a 60 delta call, and we're just looking at the bid ask spread on the 60 delta zero DT call, and we're just watching it. If all you did was watch it, and I know that that sounds tedious and boring, but I'm telling you, just try it sometime. Just watch one contract bid ask spread, and what you're going to notice is, yeah, it goes up, it goes down as the underlying is going up and down, but the spread is relatively constant. There's going to be a little bit of wiggle room, and you can kind of get a sense of it just watching it. You will begin to notice when something weird happens. For example, you'll notice that it's going up and down about $2, and even if it's trending upwards, it sort of fluctuates up and down about $2. $2, $2, a buck 80, 215, a buck 70, 225, just sort of rolls around in there. And then out of nowhere, boom, $4, right? You make a note of that. What happens next? What happens next? Well, probably something interesting is going to happen, right? There's a little bit of an inflow. Um, we might see the underlying pop up a little bit, but the point is that you can get a sense of a baseline just watching, just observing, and then you can contextualize when something weird happens and also what happens related to that weird observation. um, so that's like one kind of, it sounds like a silly exercise, but it actually can help train your mind to like seeing the kind of things that you're looking for, because you're looking for little effects like that in prices. And when you're doing that, try to remember that those aren't just prices, those are people. Those are people making decisions with risk, and there's some interesting things you can find doing stuff like that.
Well, you mentioned a funny part, which is like it's not necessarily, like fun or, super interesting, but it's where you start to find stuff. I find a lot of newer traders are actually, well, I would say like again, late stage, beginner, intermediate, probably like they're actually willing to do that kind of work if they have some sense of like what might this lead to.
Right.
So so if you think about like some of these kind of effects, and again, understanding all the nuance of it, and it's a big scale, but what are some ways that a trader can begin building an expectation of like what this can lead to so that they can at least learn to embrace that seeming boring initial style work foundation setting because it can turn into something. They just don't know what that is yet. So to summarize that, what are some ways that those kind of people can develop return expectations, any sort of forward-looking expectations of this thing that they're looking at?
Well, I'm going to start by, there's a scene in the movie Troy with
Hell
Brad
yeah.
Pitt
Yeah, yeah, yeah.
where he puts the helmet on and he's like, that's why no one will remember your name. Well, if you're only motivated to work when you're guaranteed a reward at the end of the tunnel, how far do you think you're going to get in a competitive market environment? Because the rewards, the pot of gold at the end of the rainbow here, goes to the person that's willing to do the work when they don't know what happens at the end, when they don't know if it's a certainty that there's something there. That the people that are interested and willing to search and do the work and develop a process are the people that find the results. If you need to be guaranteed the result before you start, this might not be the journey for you. With all due respect, um, but return expectations are a difficult thing to talk about. They're a difficult thing to talk about because I am probably not the best person to template. My returns are very good. You probably don't want to trade the way that I do. It is exceedingly difficult. It is high volatility in terms of the realized P&L for me, and it's quite psychologically stressful. It takes a lot of discipline to pull it off. Um, Return expectations across the board. Short vol, volatility selling. I'm pretty sure that Ewan has said something like 20 to 40% a year is like a pretty reasonable target with a sharp a little over one, like 1.2 or something. That's what I remember him saying.
I think that aligns with the conversations I've had with him. Sorry to interject there. Just one super important interjection on this thought, and I want you to explain it. Some people just heard you say, if you sell vol, just sell vol, you'll make 20 to 40%. And when I say just sell vol, I mean like just go in the open options market and just sell options, not actually. Yeah, exactly. So could you just clarify that just a little bit so
Yeah,
that
yeah, sure. I don't want to give people that idea. This is not free money options wheel horse shit, right? Um, what you need to understand about selling vol is that the risk premium is in generally in the win rate that, that short vol tends to win. We tend to stay inside the straddle implied break even on any given day, or any given period, frankly. What you need to know is that it's counterbalanced almost perfectly by the payoff ratio of long vol when long vol hits. Because when long vol hits, the payoff ratio on it is so large, as we saw, 2 or 3 days ago, um, that it almost perfectly counterbalances it. Now, are there things you can do? Yes. You can buy the tails, you can delta hedge, you can do an iron condor. There are a lot of different ways that you can play it so that you don't get cooked. Absolutely. And in the book that Ewan and I wrote, there's lots of information on that. But it's not a free lunch in the sense that, yeah, if you just do this, if you just sell vol naked, everything works out. It's not necessarily true. You have to know what you're doing. You have to be careful. And I would go a step further and say you should try to be strategic about roughly timing it so that you're selling vol when it's a good time to sell vol, not just any old time. Because if you sell at any old time, someone like me is going to take your money on the other side if I catch you on the right day or the wrong day, depending on your point of view.
Yeah, and I think that that's really huge. And thank you for elaborating on that. It's just because there are different places that try to simplify options, and then they make it seem like, well, if you just sell, then you'll make X amount. And as you just elaborated, there's a little bit more that goes into it than that. So thank you. To
Yeah, I mean,
go,
we
no,
well, I
no,
was
no, go
just going
ahead.
to say, I mean, a lot of the data on selling vol comes from like a period of relatively safe, sustained bull market, like over a decade, right? Of relatively stable, um, quantitative easing, very low interest rate. Like we're just floating up the market, right? And like basically from 2009, um, for a period of like 10 years, basically. So you want to take that with a grain of salt. It doesn't mean that other things can't happen. And like this month has been a really good example, right? This month has been a really good example. I would imagine that this has been a much more challenging month for the short vol crowd, right? And it goes to show that indiscriminately shorting vol is not the ticket. There are things to look for to give you a hint that it's a good time to sell the vol because the vol is actually overpriced. You don't want to be in a position where you're selling it to me and it's fair. You do not want that. And I'm not the only one. Obviously, there are other people out there that recognize when it's fair and they're willing to take a bet on the long side as well. So
Could you double click into that a little bit? And again, actually, you guys did talk about this a bit in your book as well, but could you talk briefly about some of the tools that a vol trader, whether buyer or seller, can use to identify if vol is relatively fairly priced versus a potential to be overpriced? And just to clarify that point really quick, the reason why I emphasize potential is obviously a lot of traders, they won't know definitively, like if this is or isn't, and then that can gridlock a decision.
right. I mean, I don't want to get into it too much, but like a very simple one is just the
Yep.
general VIX level. So when the VIX is low, right, volatility looks cheap nominally, but it's actually more likely to be overpriced just because the move that we are likely to experience that day is going to be muted. And we tend to revert back towards the straddle break even levels. So, VIX at 16, VIX at 14, the overall premium might be lower, but the lean towards the short vol crowd is much better for them. It's much better to be selling vol. If you're selling vol at 25, the premium is higher, but like there's a good chance that we're edging closer towards fair volatility. Like you could experience some real interesting movements intraday that will cause you to regret your life decisions, right? So that is it's one of them that's in the book, but I mean that's just like a basic one, right? Where um, it gets into Jensen's inequality a little bit and some other stuff, but all stuff that if you're going to sell all, you should know about this stuff. But VIX level is like kind of like a 101, like, hey, not all VIX level should be treated equally for the purposes of selling vol, if that's what you're into.
That I think is still plenty to go off of, right, for the enterprising trader, because it gives them some sort of context. And one thing that you probably will have heard or come across is this idea that when vol is high, you should sell it. And the idea there is if it's high and vol is mean reverting, then the idea is that it will come back down. Obviously, there's a bunch of holes in that. So could you talk a little bit about that?
Well, sure. I mean, it's not wrong. It's more a question of timing, right? Because not only does vol mean reverts, in the long term is one of the stylized facts about volatility. Another one, though, is that volatility clusters in the short term. And so now we're going to argue some semantics about what do we mean by short term? What do we mean by long term? Like, does long term mean 5 days? Does it mean 30 days? Does it mean a year? Because, if the VIX hits 50, it's a pretty good bet that in a year it's back down below 21, right? But that's not usually what people are interested in, right? What they're interested in is the VIX went from 16 to 22 today. Should I short vol tomorrow? And that's a different question, right? Like that's not a what happens to volatility in the long term. That's, a 2 day period or a 3 day period or a weekly period. And in a short period of time like that, it's very likely that volatility can cluster, right? Because as the VIX starts to pop up, as VVIX starts to pop up, lots of interesting things happen across the volatility surface. There are all kinds of strategies and things that have very tight risk tolerances from large operators that can blow up if things keep moving. And so the cluster effect is just as likely as the mean reversion effect on very short time frames. So it's sort of like a fake sense of security to say volatility reverts is mean reverting in the long term when you're planning on taking a trade the next day or the next 2 days. Like that's not long term statistically, in any meaningful sense. So I would caution people to be careful spouting that kind of stuff and then planning on trading in a short term time frame, I guess.
Could you go one step further and talk a little bit about the pricing dynamics as well related to that?
In what sense, sir?
The idea, so you gave a great example. If vol is at 50 and a trader was to think assuredly in that sometime over the next year, it will be below 21. So then they should buy those puts, right? Because it's going to go down.
Yeah, it's going to depend a little bit on your trade preference. Like there's a lot of things to think about there. There's a time value of money. Like, do you want a trade that's tied, has X amount of your bankroll tied up for that long? The same kind of consideration you have with season win totals in the NFL or the NBA. It's like there's a lot of edge in season win totals just for people that are interested. It's something that still has some edge even these days. But the question is, do you really want to tie up your money for the entire season? Would it not be better to maybe find some smaller edges and then, roll the compounding over the season rather than hold it in one trade like that? I guess if depending on it, if you have enough of a critical mass in it, it might be worth it. But that would be one consideration. Then there are other ways to play that trade. I mean, there are a really low touch one that you and sort of cautioned me against because it's got a lot of drag to it. But SFIX
Mhm.
is one way. that you can play that trade, right? You can just long SVIX. Um, there is some drag to that. Like it's like I think it's like 7% drag or something. It's pretty heavy. But the thing about SVIX, as much as like I'm sure that'll get shit on, the thing about SVIX is that you can just hold it. Like there's no, you know, there's no panic about like time frames or expiration. So if you really have a strong view, like, okay, the VIX is at 50 and like, if I hold this, I'm gonna get, 30-40% return on this. Like you can just park it in SVIX and you will do pretty well with it. You can, Ewan would probably be more into shorting like one of the long volatility
Mhm.
ETNs or whatever, like UVIX or something like that. But again, multiple ways to play it. As long as the time frame works for you. Um,
Yeah,
it's really a discretionary thing.
and I think a big thing to highlight there is again like the expectations because when I was making the joke earlier about like assuredly buying those puts, the main thing from like a pricing dynamic standpoint is that that same quote unquote sure bet is known. So there's not like this massive amount of capital that you could potentially make from that trade for that exact reason. Now,
Hmm.
if if you were to think about, let's say, a trader that is interested in building a model to look at something, super vague. But I want to just talk about the concepts of building a model broadly. Like, what are the considerations that you use when you're starting one? And then, we can work down the logical thought process from there.
Sure. First thing I would probably say for a retail trading audience is that modeling is super interesting. It will expand your knowledge of different techniques, the ways to process information, to sort of to look at the way that these things operate in a larger ecosystem. It's not necessarily the most important thing you can do as a retail trader. And if you just go about it willy nilly, you just kind of start firing away and dumping all this stuff into models and hoping something good comes out of it. You're going to end up spending a lot of wasted time. Um, Arguably, you will have learned some things, which might not make it wasted time in an absolute sense, but in terms of finding edge, finding profits, it might be wasted time. I'll give you an example. So I made this rolling ridge regression model a couple of years ago because I was curious about making a model for risk on, risk off. Just wanted a general vibe of like, inflows in, risk on, people getting out of the way, risk off. So I looked at credit spreads, I looked at bond spreads, I looked at we had copper, we had crude oil. I mean, it was like I had all this stuff in here that various things that generally have some effect on economic sentiment and this and that. All in all, about 25 different things. Then I, work to factor them, get the right windows, blah, blah, blah. Finally output this thing and I've got a risk on, risk off model. And it looks pretty good. And then I compared it to a 200-day moving average of the SPX. And and I'm not too proud to admit that this model performs marginally better than a 200-day moving average to the tune of like a third of 1% better than a
Hell yeah.
200-day moving average. So,
Hell yeah.
it's like 2 weeks of work to put this thing together, to get all the data feeds, to clean all the data, and the thing is basically more or less right on par with a 200-day moving average. And so it's not like I haven't made all the same mistakes, right? That I'm cautioning other people against. But if you just start building the model, what you're going to find is that there's a lot of money in the financial markets. People are highly incentivized to find things that work. And if you just randomly build stuff, what you're going to find is that someone else beat you to the punch a long time ago, and you're going to have to try a little harder and a little smarter than that. So back to the original question. about modeling. The real point of a model is to try to harness an effect. And it's something I talked about with Rob Pizzola on the Circles Off podcast is that you want to try and find an effect and then use the model to just help you sort of parameterize it in terms of how much you should risk on it or how often it wins or whatever. And so that's really the point of a model. It's not to create the perfect risk on, risk off indicator that will tell you when to jam into TQQQ or to take all your money and put it in cash. It's about, hey, like I've noticed that on FOMC day, um, we go one way really aggressively, and then the second half of the day we go the other way. And I'd like to know if I can basically fade the first move and bet on the second move. So if we go down aggressively right at the announcement time, if I jam the other direction, right? What does that look like? And then we could build a model to sort of say, okay, this is what it kind of looks like, and maybe there's something to fading the first move as an example. Um, but it's really important to try to use models as a tool to harness an effect, not just to build something because building stuff is fun, even though it is. And I love doing it, but if you start with that, it ends up being a lot of going around in circles.
Absolutely. And your story about the 200-day MA is hilarious because I think everybody that's actually traded has come across that exact thing like tons of times. And you just kind of sit it yourself and you're like, fuck.
Yeah, exactly. Yeah.
Um, Now, you chose a rolling ridge regression. I think one of the interesting things for traders is even trying to figure out like what tool to use, not in terms of like doing the modeling, but a rolling ridge regression versus some other OLS type model. Like, how does a trader, in your view, kind of build this toolkit of like understanding what might be useful to their idea?
Well, like I said, and when we talked about, knowing the rules of the game, it's important to know the available tools as well. You don't have to know every tool in the world, but there are two books that are actually pretty useful on this. Unfortunately, for many of your viewers, they're in R, not in Python. I predominantly use R though. The first is the Elements of Statistical Learning,
Mm.
which gives a really good broad overview of the various statistical models. And then there's a follow up book to that called Predictive Modeling by Max Kuhn. And they're both really good. Like that's where you're going to get into the different types of regressions. You get into, you know, KNN nearest neighbors, random forests, blah, blah, blah. Lots of, there's some machine learning stuff in there. There's also some more standard statistical models in there. Um, I think they're decent books if you're interested in sort of understanding the lay of the land in terms of the different things you can do. Um, but there are a lot of, I mean, it's an almost inexhaustible field, the number of different ways that we can try to model something. We have models where we take things from physics and we apply them to the financial markets. Then there's ecological models. There are simulations, Monte Carlo, blah blah blah. Right? It goes on and on forever. And so it's kind of about what is it that I'm trying to do, and then looking at some of the tools that are available and saying what's a what's a tool that I might be able to make work, or I might be able to kind of make work creatively, and then you just try a bunch of stuff.
For that, what are your thoughts on somebody using something like AI and like going into ChatGPT and being like, hey, I think I see this and I want to model it. What models might be useful?
I think if you ask it about the types of models that might be useful, you could probably get a pretty good answer, because I still am of the view, and it's something that Augustin LeBron said on Twitter, that AI right now is primarily a regurgitation machine. And so as long as you're asking it something that is adjacent to regurgitation, you actually can get a pretty good answer. It's when you start asking it to think, like think, that things are going to get a little bit weird. So if you said to it, for example, um, I'm trying to do a simulation of this effect, and here's roughly the effect, and I'm aware of Monte Carlo simulations, but tell me about three or four other ways to simulate something with an effect. It's going to give you a pretty good answer. Yeah, it can tell you a lot about the lay of the land. If you say, "Oh, I'm thinking about doing OLS minimization regression for this. Can you give me some other ideas about ways to approach this?" It'll give you some that are related, that are pretty good. It's just when, like you said, when you ask it for the magic solution to something, that's when things get a little hairy, in my view.
I actually saw this thing. I don't know if it's legitimate at all, and so I could be just purporting completely false information. But I saw this video not that long ago about an AI tool. It was a fake AI tool at a fake company that they were essentially emailing back and forth at this fake company that they're going to get rid of the AI tool. And they also had, different fake emails, and one of them was about like this affair that two people had. So literally, the AI tool said it shot this person an email. It's like you have 5 minutes. Either you cancel the deletion of, AI or whatever, or I send out this email with all these details of this affair. So I think I'm okay with the regurgitation part right now. That's good enough. We don't have to worry about AI not being willing to do what you want. Um, One thing that it doesn't help you with, and I think is something that catches a lot of people, is biases. The world is really challenging to perceive objectively. And when you don't even really know about your own biases or recognize them, then it's even that much more difficult. What are some ways that you think a trader can become more familiar with their own biases to then implement controls for?
Hmm. That's a really, really good question. Um, I actually think one of the more dangerous types of bias is a like a social consensus bias, and it
Mm,
happens from being a little too plugged in to what everybody else is talking about at any given moment. um, I actually think Ewan alluded to this in one of his earliest books, where he basically says, it might be surprising to some, but I never read the Wall Street Journal, and I don't read any
mm,
of this stuff, and it might surprise people because you would think, oh, this option trader, vol trader must be really dialed into like what's happening on the street, and it's like that's not quite what it means, right? He's looking at what he's looking for in the vol service, in the vol space. And if you know what you're looking for, whatever it is that you're doing, you're looking for momentum breakouts in single stocks, um, you're looking for opportunities to short shitty stocks that are pumping on some dubious news. You're looking to short vol. You're looking for volatility bursts to the long side. Whatever it is that you're looking for, there's some effect. There are some details around that effect. There's some execution skill, operator skill that you need to develop around that effect. What's happening on Twitter? What's happening on CNN? What's happening on CNBC? Not really that important to your day-to-day operations. You should try trading without any of that stuff and see what happens. It's pretty easy to turn off the television, but like, have you ever tried trading a week without looking at Twitter, without looking at whatever anyone's talking about? It's really interesting, right? How what's happening, whatever the current buzz is around um, government news, around economic calendar event news, around Federal Reserve news, it tends to really galvanize people. And if you're just after your effect, you tune all that stuff out. In my experience, you trade a lot better, because you don't have this second guessing mechanism in your brain that's saying, "Oh, but so and so was worried about this, and all those people were talking about this thing that might get us today." And it to really just try to shut out all the noise and focus on whatever the effect is that you're targeting, I think is probably the best antidote to the most dangerous bias, which I think is like the social contagion, social consensus bias. When it comes to biases about like the market's direction or the sentiment or whatever, just try to play what's there, not what you think should be there. It's really easy to get into this game of like what you think matters. Like Everyone's stupid. The market should be going down right now in this news. It's like, no, no, no. What you think is not that important. What's important is what people are betting on, what people are risking. Why they're doing it really doesn't matter when they have 10 million times more resources than you do, because when they move, everything moves, right? So like,
Hmm.
um, you don't want to be the person that's, it's trying to hold back the tide with your hands, right? You want to be the person that says the tide's coming in now, so it's time to take a step back. The tide's going out, it's time to take a step forward, and try to move with whatever it is that you're doing. And that's why what you think is less important than what's actually happening. And if you can center around what's happening, not what you think should be happening, um, tends to work out better. You tend to not get stuck in those stubborn trades where you're underwater, you're holding something that is like clearly you're just wrong. Um, I don't know if I answered that one super concisely, but that that's what I was thinking
Yeah,
on that
well,
one.
you hit on two big pieces of it. I want to double click into another side of it more, like the self behavioral biases in a moment. So things like availability and that kind of stuff. But before that, you mentioned two things that I actually think play against one another really well, and I want your perspective on it, which is this idea of kind of like social consensus against trying to fight the tide and whatever like you, the individual trader, thinks something should be. I've always felt for a while that it's really dangerous when traders get into this habit of like wanting to neatly explain and summarize everything and being like, this is happening because of this. Sometimes
Mm.
maybe, but a lot of times there's a lot of other stuff going on. And it almost becomes like this egotistical ability to explain things that creates this nasty loop. So, in the context of like navigating social environment and then managing what you think, how do you think a trader might be able to successfully extract good information, things that are genuinely useful to them, especially newer folks that are kind of starting out and like learning the landscape versus getting wrapped up into like this narrative generation side of stuff?
Mm. Well, when you're first starting out, you want to give yourself information overload. You have to expose yourself to every possible idea, even the really fucking stupid ideas,
Hmm.
because the faster that you like it's just like a jigsaw puzzle, right? The faster you map out the corners, the faster you can start filling in this puzzle. So to me, that information overload process in the beginning is all about finding the corners, finding the edges of the puzzle so that you can start filling in the pieces and start putting together some kind of coherent picture in your mind about how these things roughly work. That's different and is distinguished from when you're at a place as a trader where you have an effect that you're targeting, because now you've already identified somewhere in this puzzle that you want to attack. When you're doing that and you have one or more than one effect, now what you want to do is you want to reduce the noise, reduce the ideas, reduce the consensus activity going on around you, because you're focused on what you're trying to do. Um, so to me, those are like two separate phases
Love
of sort
that.
of like a trader's evolution or a trader's progress, right? Like like I'm sure even someone like Ewan, I'm sure when Ewan started out, he was like a sponge absorbing what everyone was talking to him about on the floor, like all around him, right? But once he knows what he's doing, like, with his vol trading, he's a lot less interested in like what bleep blog 2121 on Twitter thinks about anything, right? And rightly so, because like he knows what he's about. He knows what he's targeting, he knows what he's trading, he knows what he's looking for, what he wants, what he doesn't want, right? And so like the rest of it just falls away. And so I it's important not to get those crossed up. Like if you don't have any edge, you don't have any effect, yes, expose yourself to everything to try to map out that puzzle. But if you have some things that you're doing, you should really try to exclude the noise and focus on them as much as you can.
I absolutely love that. What a great way to describe it too. That's awesome. And now shifting back to the first part of that question on behavioral biases. Sometimes I always think, I mean, you were even talking about it before, right? About the fact that you feel a lot of traders wouldn't even want to trade the way that you trade because of the
No.
just the general toll it takes. And there's this reality where you could give two traders effectively like a straight playbook of like A to Z, do all of these things, and you're probably going to get different outcomes. And that obviously points to the inconsistencies between the individuals. And I find a really big challenge for people is even becoming aware of their own behavioral biases and then how that bleeds into their system.
Mhm.
Could you talk a little bit about just some of the more nefarious behavioral biases that you can think of? And we can even narrow it maybe to the scope of conducting research or modeling, because there's a ton that you can commit in there that sends you down the wrong path pretty quickly.
Yeah, I mean we can talk about the textbook ones, but you know, Ewan actually has a really great section in volatility
He
trading,
does.
his second book
Yep.
on that. I would encourage people to read that because it's actually really, really good. And I don't think we should rehash them here for that reason, because you should really just read them right from Ewan's second book. Let's talk about some ones that maybe aren't in there, right? One bias that, is kind of, it's lethal and it's not like a textbook one, is trading your P&L, right? Like
Mm,
allowing your current P&L to affect your trading decisions. And it's something that I struggled with in the beginning. It's something that I think a lot of people deal with in the beginning, which is basically that how you trade the next trial, the next spin, is determined at least somewhat by whether your screen is red or green and to what extent. And that's very, very dangerous. It's dangerous because it starts to muck up your payoff ratio profile quite badly, right? If you're and it turns into something else, something that's been talked about since at least the Jesse Livermore era, which is that it turns people more risk adverse when they're winning, and or sorry, yeah, more risk adverse when they're
yep.
winning and less risk adverse when they're losing. And so again, the payoff profile of your entire thing is going to go right out the window, So you say that you're targeting like I don't know. I mean, just for fun, let's just say you're targeting 1 to 1, sort of payout profile, and you're winning like 52 or 53% of the time, whatever. But your first two trades you lose, right? and now and now you become more likely to hold on to a bad trade because you don't want a third loss. So you're like, fuck it, like it's going to turn around, whatever. You start thinking things that have absolutely nothing to do with your effect. They have nothing to do with the market. Um, you stop thinking in terms of trials. You start thinking in terms of like the red on the screen, right? And then say that one does turn around and it goes ever so slightly green. Now all of a sudden you're far more strongly incentivized to take a trade for less than you should hold for, just because it's going to be a winner or just because it clears the red on the screen for the day. And so all of a sudden, this perfectly rational, logical strategy that you had before the markets open has become a complete shit show, where you're now trading to emotionally regulate yourself based on the feedback that you've gotten so far. Um,
It's awesome.
I I think that it's a very, very dangerous spiral, and it has absolutely nothing to do with data analysis, statistics. It has everything to do with your psychology, your ability to self-regulate yourself, to breathe and to reset. And so, you know, it gives some credence to the idea that even with an edge, you still need some ability to self-regulate yourself as you manage these trades. And I don't think it's appreciated as much as maybe it should be.
Two follow-ups for that. First one, there's actually, for those that don't know, there's a fantastic paper by Barbara Lee and Odine from Berkeley called the behavior of individual investors is the name of it. And it talks about the disposition effect, which is exactly part of what you were just discussing, but they go into it in detail, which is just a great read for anybody that's not aware. But the second part of that I wanted to actually double click into is this idea of path, because how relatable is that? Where you find something that you think is decent, that you know is there, at least as far as you can know, and then you put this thing on, and then you go through a losing streak right out of the gate, and you're like, what did I fuck up? How how do you navigate that? Like, how do you think people can traverse through that?
Well, Um, the first thing you should do is you should have some kind of a checklist that allows you to reset after each trade, like cognitively, psychologically. But the other thing is you want to go through kind of like a rough checklist of like the times that this effect shows up. So the first thing that pops up in my mind with this is something like trying to short vol, but now the VIX is at like 26 or 27. And you're thinking like, okay, so I've read all of these books, I've done all this research that we know about the risk premium. We know that the volatility risk premium is there. And I just started it, but I started it when the VIX was at 26 or 27. All I'm getting fucked up here. All I'm getting fucked up very badly. Like what's going on? It's like, well, again, the broad strokes you got right, but the devil's in the details, right? We just talked about when that VIX starts to pick up about how volatility starts to inch towards fair and how that's when it's a really bad idea. And you get back into Jensen's inequality and how like you should really be waiting for like VIX 16, VIX 14, whatever, right? Um, and so usually there's clues like that about like related to your effect that will tell you, hey, like it's not just that you're condemned by the gods. There may be some contextual factors here that are in play, right? It's actually kind of like say you have an edge in NFL football spreads, and you start on a Thursday, and you lose terribly on that Thursday, but you fail to recognize that like the Thursday night game tends to have smaller variance than other games because there's a tremendous amount of money and eyeballs on one game and one game only. And it does some interesting things to the total and the spread in terms of what we see for realized variance. Um, and so it's like, okay, there is a contextual factor here that maybe explains why Thursday is not the best game for this particular effect or whatever. And so usually there's something like that that can help you to put into context what it is that you're seeing. Um, like for example, if you've looked at if you look at open to close realized vol by month, you're going to notice that like not all months are created equal, right? Um, for example, I think the best short vol month there is in terms of like just a really steady equity risk premium is July, right? We just like kind of smooth roll up, and there tends not to be a lot of surprises in July. Um, and then we see that realized vol starts to pick up again, September, October, November. Um, so there are things like that where it's like, oh, if I wanted to short vol, probably July is a pretty good month to think about doing that. And probably I should ease off my aggressiveness as we get into the fall. So there are things like that that you can do to contextualize, to take a little bit of the sting off losing right out of the gate and get yourself kind of back to where you need to be.
I love that. Yeah, it's a big thing that comes to mind for that is like people that are, playing earnings. It's a good place to have a bumpy time. But,
Yeah.
now you also I have two follow-ups. The first one is you discussed a little bit about seasonality, day of the week effects, which I've always found interesting because some of them it feels like you can kind of understand why it might be there from an economic cycle, reporting cycle, whatever. And then sometimes it's like, why is this here? What is your approach when you're analyzing different kind of like seasonality tendencies, which I would also include, day of week effects and stuff like that, to determine like, is there something actually here versus is it just that 4 Thursdays in a row S&P closed down?
Yeah, that's a good question. I mean, I think most seasonality effects should be taken with a grain of salt because it's always really difficult to know how real of a thing it is. I posted one around Easter showing that like the week of Easter tends to have really muted realized volatility. So it's like a really good week to go do something else if you're looking for actual movement in the market. Um, there are some that are kind of interesting, like if you look at realized vol averages by month, you will see that July tends to be a very chill, like slow rolling, low vol grind up month. So it's a good short vol month. It's a good month to like long TQQQ and go golfing. and but you don't want to be doing that into the fall. You see that volatility, like realized vol, picks back up again. That's pretty stable over like a number of years, but you can think of why that might be, right? Like um, the big operators, what are they doing? Well, they do tend to enjoy the Hamptons and places like that during the summer months, right? It's a time when people are going to take a little bit of time away from the office, and they know that into the fall is going to be rebalancing. It's going to be tactical allocations. It's going to be end of the year stuff. It's going to be distribution. And so it kind of makes sense that you'd see a little bit of an uptick in movement towards the fall compared to the summer. At least like theoretically, like we
Sure.
can, you know, make conjecture about that. There are other ones that seem to work that I don't have any good theory for, right? Like John Carter in his book Mastering the Trade has one about like Thursday gap fills, about how like 80% of all like overnight gaps get filled on a Thursday. Like it's like the highest probability day for gap fills. And it does seem to work, but I have no idea why that would be. Um, so I
I've
guess one of the
not.
ways I navigate that is that I just make a little note that if you've noticed a really large gap and it hasn't closed and it's Thursday, you might want to at least take a look at where the gap boundary is because there's a chance that you could get a violent move there. Again, I have no theoretical basis for why that would be, but that one does seem to hit reasonably often. So, there are ones like that that I can't really explain.
Those ones are fast. I hadn't heard that one before, but like stuff like that is actually fascinating to me because the way you described it there also, I think, highlights the balance between being like a researcher and a practitioner. Because there's the research side of like, why might this be? Can I come up with something? But then there's the practitioner side of, well, it's fucking happening. So I'm still going to pay attention to it.
Yeah, and like I mean, a really good example, right, is the what was the big move? It was Thursday, November the 20th, right? I mean, that was a gap fill, right? So if you look at that move, right, we break the straddle implied break even, we go to the second standard deviation, we keep going down all the way through to fill the gap on a Thursday. So at least in your mind, right? At least in your mind, like having an idea of like where that gap fill level would be, and then maybe like taking a strike around there and paying attention to it, not a bad idea, right? Again,
Sure.
this is not like a foolproof thing, but it's something that I pay attention to. Um,
Yeah, that's absolutely awesome. That's super
so
cool. I had just one or two more things. I literally could fucking bullshit with you all day. I love trading and it's really cool to talk to somebody like you about this stuff. So a preemptive thank you. But we we were talking before about behavior biases, and one of the things that I've found personally is a lot of people will say like how stressful trading is, and I have to be honest with you. I've been doing it. This will be 19 years coming up, and I don't find it stressful. Like
mhm.
I genuinely do not. And I think a lot of that has to do with perspective and just learned experience and stuff like that. I spent a good bit of time in the military. So it's
Yeah,
like when I'm waiting stuff there versus what's going on in the market, it's like, yeah, I don't want to lose money, but that's still got all my fucking limbs. Like that's not so bad.
right.
Now, you've decided to go punch people in the face and get punched in the face again. And it's always a fascinating life choice to make that choice. And the first thing that comes to my mind is resilience and how doing stuff like that can help. Do you find that to be the case where when you do something like fighting and then you sit down at the computer and you're like, well, today wasn't ideal, but there wasn't a 260 pound man throwing an overhand right trying to cave my fucking skull in.
Well, it's an eloquent way to put it, Eric. I like that. Um, no, I agree with you. I mean, like something that it's a line from our book that I thought was extremely on point, where Ewan says trading is not a uniquely stressful job. And that is very true. I mean, it's like compared to what? Compared to being shot at, right? In the military, compared to doing like a halo jump at night or something, compared to saving someone's life as a paramedic, right? Um, compared to being a bouncer in a 20 on 20 street melee with weapons, compared to, you know, there are there are a lot of things that are far more viscerally stressful because there's a life and death element. Risking money is stressful when you lack the training and you lack the experience and you lack an edge, so everything feels like magic. It can make it very stressful, particularly if you're over betting, or if you're in a situation where you're risking money that you need to live. All of those things can contribute to stress, but ultimately, it's nowhere near the most stressful thing that you could do. Um, Fighting, MMA, all that stuff. I mean, it comes from the bouncing days, right? And it's not at the level of like what I would expect your experience was with the military, but in terms of the general stress tolerance that it builds up for dealing with high tension situations. Um, After you go through things like that, something like trading doesn't feel like this life or death, uh, you know, battle anymore. It feels more like a challenge that is surmountable, shall we say? So, but yeah, just decided, I'm not getting any younger. Probably if I want to fight again, the time is as soon as possible because I'm starting to get up there in years, right? So
How
it
old are you?
seemed like 42. I'll be
Yeah.
43 in a couple of months. So it's um it's one of those things where it's like, if you got something left in the tank, as Sylvester said in the last Rocky movie, if you still got some stuff in the basement, it's probably time to get it out while all your joints work and all that stuff, right? So
Well, the getting's
um
good. Yeah. Well, you're also in heavyweight. And for those that don't know, like, it's common for dudes to be, older than what they would consider, for like flyweights, lightweights. Like most of those dudes are fucking 25-year-old ninjas. But there's a reality when there's a little bit more mass and you have to move differently because there's always that lingering risk. And
yeah.
and, and that's there. What what made you choose? Obviously, you feel like there's something left in the tank, but there's also, as anybody that's ever done combatives, you know that there's very real risk of injury. It's not like this thing in the movies where like somebody gets like a bloody nose and their nose is set and then they're good. Like you can get fucked up. So what what made that risk reward decision to the point where you're like, I accept that risk and I want to do it for XYZ reason?
It's a really good question, Eric. That's not the easiest thing to explain.
Yep.
I guess if I was going to explain it, it's something like it's important to do things that are meaningful to you because doing meaningful things is what gives life meaning.
Yes.
It's like it's all good and well to play it safe with regards to a lot of things, right? Like, you should drive safely and all that good stuff, but like there is a time to take risks and to feel alive. You should tell that girl that you're in love with her. You should take those risks. You should sign up for that fight. Um, like I said, I just realized, hey, it's you don't want to look back 5 years from now and think, hey, I wonder what would have happened if I had taken that last fight because now I can't or whatever, right? And so I just think that the timing is right. I had some health issues for the last couple of years that I recently was able to overcome.
It's awesome.
Um, my yeah, knee injury completely healed. Blood work is like perfect now. Like everything is looking up, and it really gave me like this big boost on life where I thought, you know what? Um, I should celebrate this by pushing myself,
Right.
back to that
Yeah, yeah,
next
yeah.
level again. And
That's
so,
abs that's
yeah.
absolutely awesome. And so talk to me a little bit about like the mental preparation side of stuff. We're still talking, I guess, a little bit about mentality, but like any combatives I've ever done involves a lot of physical preparation that's kind of like a given. a technical preparation that's also kind of a given. There's a little bit of gamesmanship to that, but the
Yeah.
mental side of it is fascinating to me. So what does that look like for you? Like as you start kind of getting in the correct headspace to go into combat?
Well, I mean, the starting stuff is actually there's lots of parallels, right? The starting stuff is all fairly monotonous, tedious, repetitive stuff that most
Hmm.
people don't want to do. So if that rings a bell to anyone, you know, you can connect the dots there. But it's, you start cleaning up your diet, you're doing cardio and high intensity like interval training 5 or 6 days a week. You're adding in one or two like really heavy like kind of Menser style strength training to keep your strength and your muscle up while you're cutting weight. Um, you're making sure that your nutrition is right in terms of like you're getting enough magnesium and zinc and electrolytes and all this kind of stuff. Um, for me, it included quitting nicotine. Your viewers may notice this is the first podcast I've done without big plumes of smoke
Shout
coming
out
out
to
of
you.
the yeah. So so that was a part of it. Um, I went back to a nootropic stack that I used in law school actually to get over like the withdrawal effects. So it's been pretty breezy. And when you have a goal in mind too, it kind of like, you know, it helps galvanize you towards that in a way that makes things a little bit easier as well. But once you get all that moving in the right direction, right, you're trying to get, I would say, like within 10 or 15 pounds of fight weight, and then you start getting back into your technical training. So this is like you're getting your timing back for your combinations, your footwork, your head movement, your defense, your transition from like hands to like ground game to defense, whatever. And then, like you said, the very end, you'd be looking at gamesmanship because like nobody's edge is that they throw a good like straight cross, right? Everyone can throw a straight cross. So now it's about how do we set up the footwork? How do we, tempt the opponent into a position where the straight cross now is the correct move. And so that's kind of like the final icing on the cake where you're getting that you're getting those elements kind of dialed in. And then usually you're pretty close to fight night by around that time. So
So your fight is next year in the fall, yeah?
yeah, we're aiming right now for fall 2026. I'm not sure if it's going to be in Calgary or if it's going to be in Lethbridge, but I'll figure that out probably in the next 6 months or so when I talk to the promoters after getting through the weight shred component.
Yeah, that's awesome, man. Well, first of all, absolutely looking forward to it. Genuinely, like if it's something where people can go, I 100% would come fly and hang out
Oh yeah,
because
you should, man. You
yeah,
can come, you can definitely come get tickets. It'll also be available on pay-per-view worldwide. So hopefully, I'm hoping that we could get some FinTwit people there for sure. It'd be cool.
yeah,
That'd
it
be
would be
cool.
super cool because it like any time that I've competed, I've always preferred that, but I've developed a new genuine joy for just eating popcorn while dudes are punching each other in the face. So I will happily play the other side of the coin here for you. And I'll do my part. Do my part.
Right on. Yeah, that'd be cool, man.
Well, dude, thank you so much for spending some time talking through. We actually got through a lot of like really, really interesting details. And believe it or not, I have a sheet of notes that I want to discuss with you at some future time as well. Kind of like
Sure.
follow-ups to this session, I think could be really good. But
Yeah, we'll do
for
a we'll do a round three one of these days. No problem.
yeah, yeah, that sounds absolutely great. For folks that want to get a hold of you, where can they find your work?
Easiest place is on Twitter, X, at GingeFaceKilla. I've got a link in the top there that's got all the books and links to all the podcasts, including our previous one together. But you can find those as well on YouTube, Spotify, all over the place. So, and then books on Amazon, including the one that I wrote with Ewan that we've talked about rather extensively during this conversation.
Which is a must read, by the way. That's like one of the better practitioner level books that I could think of to point people towards because you guys include enough theoretical stuff, but you spend the lion's share of the time from a practitioner lens, which is awesome.
I appreciate that. Thank you.
Yeah. Awesome, man. Well, thank you for hanging out. And for everybody, thanks for hanging out to the end. You will catch us again, probably brief fight. We'll see how it goes. And yeah, looking forward to seeing you murder someone.
Yeah, thanks again for having me, Eric. It's been
Yeah,
great.
brother.